You ready? Okay, no, it's fine.
And he's like going
I'm
there.
just gonna end it. Yeah, we're just going to follow up, do part 2, and talk about commodities because that's where a lot of action is in the market. We've seen, actually gold is probably the best sector in the whole market since November. So what's your take on commodities right now?
Well, the gold stocks and gold, I think we have to understand is that we had a mass liquidation. And I guess maybe for another thing we can talk about inflation, deflation debate. Like I'm on the inflation side. But when we had this liquidation, a lot of people thought that was deflation. I personally just think it was deleveraging, when we had the big crash last fall. And basically what happened is these hedge funds really started for the first time to get involved in the precious metals market in 2005 and 2006. And they got liquidated last fall. And when they got liquidated, they owned these gold stocks and they had to sell them all. And it's a much smaller, more illiquid market than, say, owning IBM or something. So gold stocks went down further and faster than they have to go. And one indicator I watch is the price of gold stocks divided by the price of gold, and you get a certain ratio. Like, for example, the XAU, which is a large cap gold stocks, divided by the price of gold, historically trades at about a 22% ratio, meaning roughly if gold's 1,000, the XAU should be trading about 200 or 20, right? Well, this ratio on the XAU got down to like 9% at the bottom, and the previous all-time low was 16%. And right now it's come back up to 16%, which is, we're still historically cheap, but we're not as cheap as we were. So I just think those ratios show me that gold stocks got ridiculously cheap at the crash. So I think a lot of that had to do with just these hedge funds had to sell everything, right? And then secondly, what I believed for like the past 5 or 10 years on the long-term view is that commodities are in a long-term bull market like they were in the 70s or like they were starting in the mid-30s to the late 40s. Like these things move in cycles. And last fall, to me, was like 1987 was stocks and commodities. It'll be like a quick 3-4 month crash, and then it ends up being a good bottom, and the bull market kind of continues afterwards in commodities.
Well, when I looked last week at all the sectors in the market, I mentioned that in part 1, and I was looking for sectors that are basing out and they've look like they can break out into a new bull market. They're going from this, after you have a bear market, you have a stage in between where things tend to go sideways. That's what a lot of these commodity stocks are doing now. Not gold, but other commodity stocks like steel, concrete, agriculture. And in the whole stock market, that agriculture sector, to me, looks the most interesting. And there's like 1 or 2 stocks I mentioned on the website in particular, but it looks like that sector has the potential to really break out, by the end of the summer or something and start a bull market. So, the thing is, like all the sectors of the market, it's these commodity-related sectors that still look to be the most interesting.
And I think that's really important to look at because we're hearing a lot of talk of deflation because housing prices have gone down and the stock market went down. But all you have to do is Jim Dines is saying, the famous newsletter writer, don't think, look. So you look at your charting patterns, you look at these things, and like you said, these commodities are showing big signs of basing out. And oil, of course, is now kind of broken out to over $65 a barrel as we're speaking. So what we're seeing is they're acting better than anything. So rather than just being stuck on a belief that deflation's here because housing prices went down, you should be looking at the charts which are acting best, which are the commodities. And then the second thing that no one talks about is, we're on a fiat-based currency system. We have been since the early 70s when the U.S. got off the gold standard. So basically, ever since, and the Fed just prints money all the time, and this money is always looking for a place to go. And in the 70s, it was hard assets, right? It was commodities. In the 80s and 90s, people said there was no inflation. That was a lie. There was asset inflation. Housing prices went up, stock prices went up, all that sort of thing. So all that money looked to go into that. And then for whatever changes, let's forget why it happens. It just happens. Then you've got to get another shift. And I think in early 2000s, we shifted, again, from assets into commodities. And this kind of housing bust is kind of the nail in the coffin for assets. And we'll, again, continue this commodities bull market. Because the funny thing I always laugh at when I'm like watching Bloomberg or CNBC or something is that there's some analysts saying, oil should pull back because, the economy is still fundamentally weak. Well, the economy was weak in the 70s, but oil went from like a few dollars a barrel to $40 a barrel. And they don't realize that if you get a devaluation in the U.S. dollar and you get all this money looking to go into assets, that can cause the bull markets maybe even more than supply demand. And I think people really have to understand that sometimes maybe the economic fundamentals won't represent what happens in the market. And I guess the next thing we're going to talk about on this little segment is that the U.S. dollar it's kind of looks like it's rolling over, and the strongest looking currencies on the other side of the coin are Aussie dollar, New Zealand dollar, Canadian dollar, like commodity kind of based currencies. And actually, one reason I really started getting bearish in the U.S. dollar and thinking that was the rally that happened late 2007 or late 2008, early 2009. If you look at the charts of the Canadian dollar and Australian dollar, they were talking about this sideways movement at the bottom. They had these beautiful bases they built from about October of last year till about March of this year, and now they're coming out of those bases. And that's what kind of a mentor, Mike and I, named Stan Weinstein, would call a stage 2 bull market. That the bull market is just beginning out of that base. Now, in the short term, I think U.S. dollar is extremely oversold, and it should bounce. But this is all coinciding with the policies that being taken, like the printing money, the monetization of the debt, all that sort of thing.
Well, at the beginning of the year, you recommended a really good trade in your newsletter that I subscribed to, where you talked about shorting the long bond.
Yeah.
And of course, we had a big drop in that and rise in TBT, which is the ultra short ETF for the long bond. And then recently, you recommended just to hold a core position and then
take the short-term profit. Yeah.
Take the short-term profit. We're getting a little bit of a bounce there. Do you see any correlation between what you're saying in the dollar and what's going on in the bonds?
I think it's not so much I think the doom and gloom scenario was always that foreigners would dump all their dollars and that was it. I think it's more that they're just seeing less assets flow into the U.S. at a time when they're issuing all this debt. And then secondly, like you look what happened on Friday, the bond was up a lot, but the dollar tanked. And I think that is because the reason it was up is because the Fed was buying, like not foreigners buying, right? So, and that means inflation, more printed money, bearish for the dollar. So, but I definitely think this weak dollar is coinciding with this burst in the bond bubble because it's less inflow to the States. George Soros calls it the super bubble, where all these assets flowed into the United States the past few years, and then Americans could live beyond their means because of they were getting all these asset flows in. And then in turn, they were buying the foreigners who were buying their assets, they were buying foreign goods. Mm-hmm. So foreigners actually were supporting the U.S. living above its means. And I think that super bubble is kind of ending. And just so you know, you're talking about my newsletter. Yeah, early in the year, I did a little piece called 3 Investments for 2009 and Beyond. All 3 of these investments are at least up 30, 40%. One was actually an entertainment company, one was a car company, and one was the shorting the long bond. And by the way, I think the long bond trade's still very early in its fruition. I think it will top out soon or on this bounce, and I think this is a 2-3 year thing where you're going to see it move. Like, I wouldn't be surprised, and this may sound crazy, if by 2011, 2012, the next election cycle, we're nearing double digits on the long bond. That's how much I think it's a bubble. I think it's a total going to be a complete disaster, everything that's happening right now for that.
Well, if you're saying we had this super bubble system that was supporting everything, with the money flowing in the United States, and we're buying the goods from overseas, and that appears, like you're saying, we're seeing signs of that starting to change. Maybe the rise in gold is a symptom of that. But if that's changing, what's coming? What's the next big bubble? Or what's the
I think commodities will be the next big bubble, and I'm calling it also a debt bubble, where if you look at the U.S. debt as percentage GDP, that will do the hockey stick straight up curve. And the good news is it usually comes collapsing down, but how's it going to come collapsing down? Going to print their way out of it or it's not going to be good when it collapses, but no longer, but it's probably going to happen. And see, but I think the shift in Asia is, if you look at China's stimulus, they were basically giving people coupons to buy goods. So Asia now is they got 3.6 billion people, they're emerging markets, they're growing fast, they don't have the bad, only $3 billion of subprime losses in Asia, so they don't have all the bad toxic debt. And they're going to try now to build domestic demand rather than depend on the States. Now, this is a shift that might take 3 to 5 years. It's not something that's going to happen overnight because Asians are such large savers. But I think that's the shift, is that rather than depending on the U.S. consumer living beyond their means, they create their own domestic demand.
Well, the whole key to making money,
which is also positive for commodities, because you have 3.6 people buying cars, fridges, or whatever.
That's why that's why these are the markets that look the best too. Yeah. The Asian markets and the commodity markets at the same time. But that's the whole key to making money in the stock market, is trying to recognize
trends,
these new trends and shifts when they start, so you can get in on them. And then when you're doing something that's working, you stay with that until it's not working as well. Then you get into something that's new, that's coming up. So that's the game plan, and that's what we're doing. And we'll be talking to y'all later.
Thanks.